Hello, good morning, everyone. Welcome to all of you for today's session. Students, just let me know whether you people can hear me well. Can you hear me well?
Yes,
Yes.
sir.
Yes, sir.
Right. Now, the topic for today, the first topic is audit risk, and a very important topic it is. And here we go. What is audit risk? Before going towards that, I told you in the last class a topic risk of material misstatement in financial statements. Risk of material misstatement in financial statements. Material misstatement. Misstatement means what is misstatement? Misstatement is something that some item in financial statement may be understated, overstated, omitted. Yes, some item in the function may be misstated. Risk of material misstatement in financial statements. So when we talk about risk of material misstatement, so students, basically auditor need to identify those areas of financial statements which are most likely to be misstated, which are high risk of material misstatement. And so that he can direct audit effort towards those areas. Now, so what is audit risk? What is audit risk? Audit risk is that the risk that audit report may be inappropriate, that the report which auditor is going to issue on financial statements. Well, we know that audit report is the ultimate outcome of audit process. And if that report turns out to be inappropriate, for example, auditor says financial statement give true and fair view of company affairs. And in fact, financial statements were misstated. An auditor could not detect those misstatements. So auditor's report may turn risk means some chances of occurring that the audit report may be inappropriate. Now, students, audit risk. Now, this is the situation where auditor, if it happens that report turns out to be inappropriate, what will happen? What will the consequence? What do you think? So first of all, reputation damage. Auditor's reputation. Second, it may have legal consequences. Anyone can sue auditor that auditor was negligent. Reliability of audit profession will be damaged. Now, so that's why, so auditor wants to reduce audit risk to an appropriately low level. Low level. An appropriate low level. No, I have used appropriately low level. Acceptable low level. And of course, acceptable low level depends that how much risk is acceptable. That depends upon professional judgment of auditor. that depends upon professional judgment of auditor. Now, next point. And now the point is how to reduce audit risk to an acceptable low level. Audit risk can be reduced to an acceptable low level if there are components of audit risk which actually cause the increase in audit risk for the company. Those factors which are actually causing this audit risk, contributing to this audit risk. So we need to identify those components. And the first component is risk of material misstatements in financial statements. Risk of material misstatement in financial statements. Risk of material misstatement in financial statements. Now, what does it mean? We know that auditor has to plan and perform audit work to detect all material misstatements. Remember, in the last class we discussed? And if risk of material misstatement. Now, students, if there are so many misstatements in financial statements, if this risk is high, audit risk will automatically high. Auditor may not be able to detect all. If it is high, audit risk will automatically be high. Now, so risk of material misstatement in financial statement. The first point is inherent. Now, why an item? Now, students, tell me, who is responsible for occurrence of misstatement in financial statement? Who is responsible? Tell me. Who is responsible? Tell me, please. Management, exactly. It is management. They are the misstatements because financial statements are prepared by management. And if financial statements contain misstatement, it means management is responsible. Management is at fault. So misstatements in financial statement occur. So this risk is because of management. Financial statements may be misstated. Why? Because management might be at fault. So the first factor because of which misstatement may arise in financial statement, that is inherent risk. Inherent risk. What is inherent risk? Inherent risk is, listen, I am the manager of company, finance manager. I am going to record development cost in financial statements. On the other hand, I am going to record electricity bill. Two costs. Tell me where chances are that I may commit a mistake in recording? Tell me. Where there are more chances of errors by me? Development cost. Why? Because it has a detailed criteria. It has a detailed criteria to be complied with while recording that item in financial statements. And I may not apply that well. This is the possibility. So inherent risk is a high for development cost. Another example, director's bonus. Director's bonus is one amount to be recorded. On the other hand, the second amount to be recorded is, item is recorded is, that is rent expense. Now, director bonuses, I may manipulate because it is related to, by default, nature is like that. So inherent risk is the risk of material misstatement in financial statement due to nature of item to be recorded in financial statements. Nature of item, which is present by default in that item. For example, in the nature of item, let me give you some. For example, there is detailed criteria involved, complex criteria. Complexity is there. There is subjectivity involved, judgment in the measurement, recording. Yes, or any bias involved. Director bonus is my bias. I'm director of company. I may manipulate it. So these items have more chances of misstatement. Yes. Now, so this is called inherent risk. Is that clear to everyone?
Yes, sir.
Is that clear?
Yes, sir.
Good. So the second risk of, management is recording these items in finance statements. The second is control risk. Control risk is the risk of material misstatement in financial statement due to weak or inappropriate controls. Due to weak or inappropriate controls. Yes. Anybody can change the data, customer data. Authorization is not required for entry. No one is being checked. Entries are not being checked. Yes. Now, students, control risk. When entries are not being checked, when there is no internal audit department. So controls are not being monitored. Controls are not being checked. So high chances of misstatement in financial statement. Controls may be weak related to financial statements. Now, the second is detection risk. What is detection risk? Now, you see here, auditor has no control over it on the risk of material misstatement. Control or contribution even in it, but it is causing audit risk for the auditor. Because if financial statements may be misstated, so audit risk is high. Audit risk will be high if financial statement may be misstated. Yes. Now, detection risk. The risk that now it is related to auditor. Auditor may not be able to detect material misstatement in financial statements. Yes, auditor may not be able to detect. So this is the risk which is because of auditor. This is the risk which is because of auditor. Auditor can manipulate this risk only. Yes, auditor can manipulate, can change this risk only. Example, we are going to audit a company for the first year, new audit client. For us, we have not audited them before, so we may not have the idea of financial system of company, accounting related issues of the company. We may not have detailed knowledge, detailed idea. Yes. So hence we may not be able to plan audit work properly. And we may not be able to detect misstatements. Second example. Second example. That is, client has multiple offices, warehouses, etc. Multiple offices or warehouses. So we may not be able to visit all. And we may not be able to, what we can say, check every item over there. Means every office, sorry. So detection risk is there. Yes. So or detection risk, it arises because of various other factors as well. And we will talk about that. So audit risk is equal to risk of material misstatement into detection risk. Risk of material misstatement into detection risk. This is called risk equation or risk model. Since it is equal to inherent risk and control risk, so it becomes audit risk is equal to inherent risk into control risk into detection risk. Now, next. So tell me, audit risk and risk of material misstatement. What is the difference? I am all ears to your answers. Tell me, what is the difference?
Detection risk.
Yes, please. Anyone else? Thank you, dear, for responding. Anyone else who can explain it in a better way? In another way. Not better, you can say. It was good. Yes, please. Anyone else who can explain it? Yes. Tell me, please.
Audit risk is a combination of inherent risk, control risk, and detection risk, whereas risk of material misstatement includes only inherent and control risk.
Okay, good. Right? I appreciate. All risk of material misstatements are audit risk as well. But all audit risks are not risk of material misstatement, as it includes detection risk as well. Is it clear? This point is clear. Tell me.
Yes, sir.
Yes, sir.
Good. Now, let us proceed further. So we have gone through all this process. Students, that what is audit risk, what is risk of material misstatements? So, in exam scenario, examiner asks you, the question is like that: evaluate or explain risk of material misstatements in the financial statement of this company, or explain audit risk identified in the evaluation of yes, or in the planning of company XYZ. These two questions are normally there. Now, next. So students, two questions are there, two types. Now, when we are writing this answer to this question, we have never discussed detection risk. It will be blunder. The first point, it will be blunder. But yes, if we have asked, now we are relaxed. We can talk about risk of material misstatements and detection risk. Yes, ground is washed without in front of us. Now, let us proceed further. The next point is, so we are talking about exam, right? Exam focus points. The first point is clear here. The second, sometimes they say in exam, explain significant audit risk. So word significant is there. So significant means all risks specific to scenario. Specific accounting issues, whatever is given in scenario, when we are discussing that, they are significant audit risk. All detection risk, yes, again significant to scenario, they are audit risks. So students, the next point is for significant risk, which are, so just give me 1 minute, please. Just 1 minute. Yes. The next point is now how you will find data in the exam scenario and where you will find when you are discussing. In exam scenario, different exhibits are there. Exhibits. So you will find data from the general points, general audit risk. General point, discussion. General point means discussion. Second is, you may find accounting issues. Accounting issues. And third is analytical procedures, results. Analytical procedures, results. Now, listen, please. Accounting issues. Remember, as I told you, that audit risk can be detection risk and risk of material misstatement. I told you. And you can find them, yes, three pockets. Three pockets. Remember one thing. If you are explaining the risk of material misstatement, analytical, for example, you are calculating ratios and you are checking the trend. Accounting issues, normally they are risk of material misstatements. So how to explain? How to explain? We have to remember, justify. We have to explain the issue, explain the matter, and tell how any item in financial statements may be understated or overstated. Any specific item. Explain. Tell specifically which item. So when we say explain, so the word explain has, yeah. If you are explaining accounting issue, what is the accounting issue? Some IFRS treatment. You will explain or you will give concise accounting treatment as per relevant IFRS. Give concise accounting treatment as per relevant IFRS. And then apply it to the scenario. To explain how given treatment may be understated, may be wrong, and may be wrong or is wrong. In certain circumstances, given treatment will be confirmed wrong. Apparently, they have told wrong treatment. Then you have to tell given is wrong. Where clear incorrect treatment is given, we cannot say it may be incorrect. No. If you are saying that it may be incorrect, examiner say you are incorrect. You will not be granted marks. Now, next point. And which item in financial statements may be understated or overstated? may be understated, or if it is wrong, which item is understated or overstated. Now, let us proceed further. Student, this is clear accounting issue, how to solve accounting issue. Read it once again. Read it once again and tell me, is it clear?
Yes, sir.
Good. Let us proceed further. Give concise statement and yes, last point which I missed, which should be the first point. Yes, calculate and discuss the materiality of amount involved. Calculate and discuss the materiality of the amounts involved discuss. Yes, that whether it is material or not. Item is material to financial statements. Just a minute, student. Just 1 minute, please. Just 1 minute. Yes, now it is going to be, yes. So student, accounting issues. And where you can find accounting issues? Where you can find accounting issues? Accounting issues will be present in discussion of paragraph. They may be present in the extracts of financial statements and notes to financial statements. They may be present in two places, accounting issues. In discussion of paragraph No extracts of financial statement and notes to financial statements. You may find there. Yes. Next point. So accounting issues I have discussed. Now come to the analytical procedure, which I have already discussed with you in the last class, by the way. Analytical procedures, again, I have given you the solution above. How any item, yes. So explain the trend, ratio, the trend or ratio from scenario. Scenario financial statement. That how an item in financial statement may be understated or overstated. And you have to discuss that ratio and how you have linked and which item may be understated. Tell specifically which item may be understated, which may be overstated, and support the explanation from other evidences from scenario. I will explain this point. Note it down, I'll explain with example. Don't you worry. Now, let us proceed further. Let me give you an example. For example, we have seen that from the financial statement, GP margin last year, this year, net profit margin last year, this year, 30%, 30%, right? Net profit margin last year, 15%, 18%. Now, we say that, what is the risk? Gross profit margin is same. Net profit margin has increased. The management of company may have manipulated it. What manipulation? Now you have to explain it. They may have missed some cost. They create some cost deliberately to show Net profit margin high. For example, in the scenario, another item is written there that directors' bonuses are based on increase in net profit margin. It is given in the scenario. Other information. Somewhere else, you will link here that you see here. Director may have manipulated it just to secure their bonuses, which are based on net profit margin. Or another example. For example, it is not there. Another information is there that provision for provision for warranty claims have been reduced by 10% from last year. So we say that they may have manipulated warranty, costs reduced deliberately to show increased profits. So such logic from somewhere else, we find that's wonderful. Is it clear?
Yes, sir.
Yes, sir.
Now, next point. The next point is yes, generic points, which may be related to audit risk or risk of material misstatement. In scenario, just like that, I told you new audit clients. New audit client is an audit risk. How? Because auditor may not have the previous knowledge, detailed knowledge of financial situation of the company, accounts of the company. Auditor may have not any knowledge, detailed knowledge, and hence may not be able to plan and perform audit work properly. Possibility is there. Second point. No internal audit or with no or understaffed internal audit, no audit committee. So financial statements may contain misstatement because controls are not being monitored, not being improved, and hence control may become weak. Financial statement may be misstated. There is possibility. Next. So students, you may find such number of points. Directors bonus to be paid out of based on net assets increase. Yes, general point, but it had direct impact on financial statement misstatement. explanation, proper explanation that why and how a misstatement may arise. Yes. I hope it is clear to you people. So these are how to draft answer for audit risk or risk of material misstatement. Yes. So we will proceed toward past exam paper questions. So let us start with the TED company. Vancouver is here. TED is there. Okay, Adams Group will be our first question. Very good. A wonderful question it is. Adams Group. Question number 4 we'll be starting with. So I would suggest to you take 5 to 7 minutes, read this scenario one, everyone. Then I will be discussing it with you. Be quick, please. You have 7 minutes. Now, so they say that audit risk to be evaluated. You see here, two. So it is starting, you are an audit manager in the Dandu and Company, a firm of chartered certified accountants responsible for the audit of the Adams Group. Your firm was appointed auditor in January 2014, and the auditor your partner, Jeff Day, has sent you the following email. Okay, from regarding, I need you to begin the planning the audit of Adams Group. As you know, we have been appointed to the audit to the group financial statement, and we have appointed to the audit of the company subsidiary, except for an overseas subsidiary, which is audited by a local firm, Clapton. All components have the same year, right? So this information is given. Notice how many marks they have. It has 18 marks. Now, one more thing I forgot to tell you, which are regarding the solution. Remember, each audit risk which we have to discuss. Okay, I will open the leave it. I will open the examiner report in front of you, and we'll discuss with you with that. Okay, come here. The group operates in the textile industry, buying cotton, silk, and other raw material to manufacture a range of goods, including clothing, linen, and soft furnishing. Goods are sold under the Adams brand name, which are acquired by Adams Company many years ago and is held at original cost. Adams brand name? Held at original cost. Now, next. Many years ago, it was acquired. Now, we are reading, and if we try to see the financial statements to see if there is any information available, brand name. So one accounting issue is there. So how to discuss it? They say it is held at original cost. Now, before going for the answer, drafting of answer, what comes to mind? What we need to do about it? $8 million is the cost. Brand, Adams brand, was acquired number of years ago. Yeah. Still held at cost. Now, what to do about it? So students, the point is we need to calculate its materiality. First of all, total assets, here they are. 8,107 million. So materiality. Now, I'm not drafting answer right now. I'm just asking you, I told you the brief, concise treatment from the accounting treatment from the IFRS. We need to tell what can be that. For example, the brand Purchase brands are held at cost, but later on, they should be amortized over their useful life if they are of definite life. Or they should be tested for impairment if they are of indefinite useful life. If they are of indefinite life. So, Adam, now they have told it is held at cost. Whether the given treatment is incorrect or correct, we cannot say. We cannot say over here because this valuation may still be correct if it is of indefinite life and it is not impaired. So I will explain, don't you worry. So Adam's brand. Now focus. The brand is 8,107.5 million. How much percentage it is? 7.4%. Total assets of company. Tell me, is it material or not? Tell me. Is it material or not?
Material.
It
Yes,
is
material.
material. It is material to financial statement of students. When you will read examiner's answer, you know, in my opinion, examiner confuses the students because answer can be structured in a certain way, easy way, with all same requirements, but examiner answer is quite confusing normally. So the components which I have told you in the answer, those components should be present in the answer. Remember that. Those components should be present in the answer. The materiality is there. Now, accounting treatment as per IFRS. As per IFRS, we don't remember the number of IFRS. No worries. Number is not required. Now, concise treatment as per relevant IFRS. Purchased brand should be amortized over its definite useful life. But if brand has indefinite life, it should be tested for impairment at least annually. And impairment loss, if it is there, should be charged. Now, this is concise, relevant accounting treatment, which I have explained. Now, next point. Not completed yet. Now, applying the same treatment to scenario. Applying the same treatment to scenario. Yes, we need to apply that. How to apply? You see here. The Adams brand is still held at cost in financial statements. It is still held at cost in financial statements. And may need to be amortized if it has useful life. Because we are not given any detail. Yes. Or if it has, so it has definite useful life, sorry. Indefinite useful life and impairment loss may be required, which the company has not recorded. Which the company has not recorded. And risk is that intangible assets, because Adam's bad intangible assets, may be assets and profits may be overstated and expenses understated in financial statements. Now, next, you see here, this is how you have to explain the point. This is how you have to explain a point. Treat materiality, treatment as per IFRS, applying to scenario, and what is the risk and impact, which item may be understated, overstated. I think it is clear. Now, next point. Ross, Linott, and Beard Company are all wholly owned, acquired subsidiaries, which manufacture different textiles. Adams Company also own 25% of Stewart Company, a company which is classified as associate. Statement of financial position value is $12 million at 31st May. The share in the Stewart was acquired at 11.5 million. Now, yes. So students, Stewart Company, associate. How to explain it? Stewart Company. Now listen. Right now, 12 million. Its materiality to the group. We can calculate and discuss. Further, treatment for IFRS, IS 28. We say that when a company has significant influence in another company through voting powers or an appointment of directors, of company. Yes. Then it is called associate. Significant influence. Okay, tell this treatment. So students, here they have purchased 25% shares of company. Stewart Company. Adams Group have purchased. You can note on these points. I will not draft full answer for it because one model answer I have given to you, but I'm explaining the point in the same sequence. Here, the Adams Group has acquired 25% shares of the Stewart Company, but it may not have 25% voting power. Or may not have right to appoint directors of company. So it may not be regarded as, it may not be fulfilling the criteria to be held as associate. Now, next. But on the contrary, if it meets the criteria to be held, to be declared as associate, so as per IFRS, further points, investment in associates should be recorded using equity method of accounting. Equity method of accounting. The risk is that the company may not have applied equity method of accounting properly. And its assets may be misstated. Understated over both possibilities. Both possibilities are here. Now, next, let us proceed further. Students, are you able to understand the whole, writing the answer is not something that you are just noting down what I'm saying. Try to understand the art. The failure in P7 AAA is because of two reasons. One, lack of knowledge of IFRS. And second, when you have knowledge of IFRS, but you don't know how to write answers. This second reason is the biggest reason. When we say there is a skill, analysis and evaluation skill, 20 marks. It's not here. Let me share with you people. Just a minute. Let me share with you because I have to teach you skills along with it. They are in the volume 1 at the start. Am I right? Or it was a separate handout given? It is here, yes, at start. You see, analysis and evaluation. application of knowledge on the scenario. Assessment of financial reporting issue. Treatment as per IFRS and applying to the scenario. What is the situation? Which is correct, which is incorrect, what may be misstated? Calculation, materiality, for example. Analysis and evaluation skill. And remaining skill we will talk about one by one. Then we'll be discussing the topic properly. So that's very much important, which I'm teaching the same to you. I'm drafting the answer. Now, next point. The next point is, Ross company manufactures luxury silk clothing with almost all of its output sold through approximately 200 departmental stores. Ross companies draft statement of financial recognize assets of this. Yes. Any silk clothing which has not been sold 12 months is transferred to Linot company. First of all, Ross company's materiality. M, materiality. You will discuss to the group. So, students, it is happening they say Ross company is selling through stores. And so first of all, the problem is here sale. One thing. Sales, revenue, recognition. So materiality discussed then. IFRS 15, by the way, this says that a revenue should be recorded when performance obligation is satisfied. When a performance obligation is satisfied, when control of goods is transferred to the buyer. Second point. Here, the Ross company is selling through 200 department stores. and any goods unsold are transferred back after 12 months. Applying to scenario. So goods which are present in the store, they are still related to Ross company. So a sale should be recorded only. So a sale should be recorded only when goods are sold from stores to the final customer. Applying to scenario. The risk is that Ross company may be recording revenues when the goods are still at store. Hence, revenues may be overstated. Now, next. So you see here, applying to scenario, risk, and which items may be understated or overstated. Now, Linode company is located overseas, where it can benefit from low-cost labor in its factory. Its price produce low-price fashion clothing for the mass market. A new inventory system was introduced. Yes. Generic point. General point. New inventory system. Students, new inventory system. At Linode. To generic point. We can explain it in two ways. New inventory system was introduced to control the inventory movement between factories and stores. And you can discuss the materiality of Linode as well. Materiality to group fund statements. Okay, so the risk is that the staff may not be well trained to use the new system properly. new system properly and committing errors in recording those items, resulting in both possibilities: misstatements of inventory in financial statements. Yes. Now, so student, the next point is here. Investment property. The company is cash rich and surplus cash is invested in the large portfolio of investment property which generate rental income. The group's accounting policy is to measure investment property at fair value. Okay. Recognized at year end 28 million, out of which investment properties are 10 million. So you will discuss its materiality to the group. Materiality to the group. Investment property. Gain this year. Okay, here is the gain. And investment property increases here. So we 2-3 points are there. First of all, materiality discussed. As per IFRS, although I know IAS 40, but for you I am saying as per IFRS. Investment properties can be valued at fair value model basis. But any gain or loss should be recorded in the profit and loss account. Any gain or loss on fair value should be recorded at any gain or loss in the fair value should be recorded at in the profit and loss statement of company. But here, in this case, gain or on property revaluation has been incorrectly given. You see here, has been incorrectly given in other comprehensive income. In other comprehensive income. Which is against IFRS provision. Secondly, gain in, secondly, the next line. Secondly, the gain in income statement is 1 million on the investment property. The gain in income statement is 1 million on the investment property, while in the statement of financial position, it has increased by 2.5 million. It has been increased by 2.5 million. So there is risk that gain in income statement is understated. Yes, understated. Now, next point. This point is done. As part of the management strategy to increase market share, the bonus scheme has been put in place across the group. Bonus. They will see a bonus based on revenue increase. Great. So revenue, how much increased? We can calculate. Revenue increase 725 divided by 625. 725 divided by 650, sorry. It is 11.25%, 11.5% increase in revenue. So, students, the bonus, how we will explain the bonus? How we'll explain? The revenue of company has been increased by 11.5% from the previous year. %11.5% from the previous year. There is increased risk of overstatement of revenue as the senior manager's bonus is based on increase in revenue. Secondly, in the next line, secondly, the bonus of senior management should have been recognized as expense. And as accrual. In financial statements. But the risk is that they have not recorded any entry relating to that in financial statements. So liabilities and expenses may be understated. May be understated. Yes. May be understated. Next point. Now, so students, the next point is management charges. You see here, 800. First of all, materiality for the group on each of its subsidiaries. So 3 subsidiaries. So 800,000 into 3, 2.4 million in group financial statement. 2.4 million receivable. In the group financial statement. Those 3 subsidiaries, they have 3 or 2? Yes, 3. So materiality of 2.4 million. You will say the management charges from the 3 subsidiaries will be 2.4 million, which is material to financial statements of the group. Now, next. As per IFRS, the intra-group receivables and payable balances. Intra-group receivables and payable balances should be eliminated upon consolidation. Upon consolidation. Upon consolidation. This 2.4 billion from the group financial statement should have been removed as receivable and payable. The risk is that they may not have done so, and hence receivables and payables may be overstated. May be overstated. Now, students, this question is done, completed. Now, what I want from you is, I want you to solve a question from home as assignment. You will convert that into PDF. Answer, type. I want you to type the answer. Okay, here is the question. Margot company. It's A part, 20 marks. Risk of material misstatement. Risk of material misstatement. 20 marks. You have read maximum points. You will type the answer. Please do not try to copy paste from the standard answer. If you are trying to do so, you are doing two things. First of all, you are trying to deceive yourself. Because sometimes students do, when I emphasize, the must be done, I will not spare you. Then they do, they just copy paste and try to do some word change. And I am tutor. Triple A, would you believe I have tutored more than, if I say, 2,000 students only for triple A. That is not wrong. More than 2,000 for triple A only. It's 10 years, 12 years teaching triple A around. So that's why when a student do such things, so please, I will not identify that the student have done the copy paste. Because if a student is not sincere with oneself, how can I force that student to do better? Then second thing will wastage of my time when I'll be going through that answer. Please try to solve this question by yourself. Do maximum mistakes. Maximum mistakes, I'm telling you, which you can do in the natural way. But before doing that question, you need to go through 2 days lecture, which I have done with you. All the details. Okay. So in the next class, I will be marking your assignment. So I want you, if you can do this to me, I can do is I can mark it at home. And in the class, I can discuss your issues only. Okay. Otherwise, if you will be sending late, then of course, I may take the class time in the class. So please try to send me the solution. My email address, please note, link to Hamza @outlook.com. In the subject, please note down this instruction. Write triple A batch A, and the question name is Margot Company. What you have to do, these instructions are very important for me to be able to mark this question. They're important. Yes. What you will be doing PDF file. Convert your document into PDF and then email that. And if you do, that the PDF, name of PDF file, your own name. And today what we are starting, this has a 90% role in your getting passed. If you are not practicing the way I'm telling, I'm guaranteeing you will fail. I'm sorry to say. And when students come to me, we fail. I say you do not do assignments. You try to escape from the assignment. And it is very difficult task for me to mark assignment because I don't delegate it to anyone else. Because I consider it's important. Now it's your turn to consider it important. Please. This is mandatory. I request you in the next 2 days, in 48 hours. Okay, make it 72 hours because you have to revise the lecture as well. First, you have to prepare the lecture, 2 days lecture. Then you will solve the assignment and send to me. In the next class, I will join. I will be doing practice. This practice question is on audit risk. I'm telling you. Same. Then I will come to the business risk. I need to solve one more question, minimum, maybe doing 2 questions on it. I'm telling you in advance. And if I need it, I may conduct one additional session. You should be getting ready for practice of audit risk. Because 3 to 4 questions I want to do in class on audit risk. Got it? And alone I cannot do. I can play my part. Now, come here. So Margot company is your home assignment, remember. So come to another question. Let us go through another question, which is here. And I'm telling you, if you solve Margot company, in the next class, I can discuss the next step. There is a process through which I have to move you people so that you can prepare your, step-wise things I have to tell. I cannot tell everything about the question. Same level, this level you have to cross. Then I will tell the next thing. Okay. The next question is here. Delhi company. December 15th.
Sir, I have a small question before we proceed with the doll company. The requirement for the previous question was to discuss on the audit risk. All we've discussed so far is a risk of material misstatement. We did not discuss about the detection risk.
Very good question.
Will the examiner penalize us for this section?
Okay. Okay. A very good question. I love if you want to clear your confusion. If you stay silent mode, you are not asking questions, you are not responding to my question, that makes session boring. Boring for you people. Less learning for you. This girl, this student, wonderful. I appreciate her. I didn't see who she was, but she has asked wonderful questions, who she was. Now, the point is, listen, I will be answering as well. All risk of material misstatements are audit risk. Simple as that. If you have written only risk of material misstatements, so they are automatically audit risk. They are automatically audit risk. Examiner wants that for 18 marks or 20 marks, have you made enough points or not to cover 20 marks? Whether you discuss detection risk in it or not, it is not relevant. It doesn't matter. Since all risk of material misstatements are audit risk by default. So when you are discussing audit risk of material, it means you are discussing audit risk. Now, so now in the next class, what I have to do is, I told you a few minutes ago that I will be discussing the next points on the basis of if you prepare today's task. I have to tell you the marking scheme. How many points for each question? How marks will be distributed? For 18 marks, how many points you have to write? For 20 marks, how many points you have to write? I'll be telling you. So the one thing, the answer to that girl, that you have not to write detection risk, that is not mandatory. Because when you are writing risk of material misstatement, they themselves are audit risk. Okay, is that clear? The second,
Yes, sir.
you have to choose number, how many points? You have to choose as per the marking scheme, which I will tell you. Is that clear, dear? You asked the question, I'm asking you.
Yes, sir.
Is it
Thank
clear?
you.
Welcome, welcome. Now, next. So, Delhi company. The next is Delhi company. I would suggest to you, here is the students. Can you hear me, everyone? Can you hear me, everyone?
Yes.
Yes.
Okay. So I would suggest to you, please, Delhi company question. Everyone, please open this and read it carefully. You have 7 to 8 minutes for it. You need to identify all the points, audit risk from it. Okay? You will be identifying audit risk. Then I'll be discussing it with you. Yes, students, now. So I hope you people have gone through the question. Now we will be discussing that. You are a man, so the requirement is the same, audit risk, 18 marks. So you are a manager in the audit department of Mondrain and Company, a firm of chartered certified accountant. You are responsible for the Delhi company, a listed company in the design and manufacture of equipment and machinery used in quarrying industry. You are planning the audit of financial statement for the year ending 31st December. So the revenues, profit, and total assets. It became newly listed company. It is the first factor, the first point, because of some misstatement may arise in the financial statements. Why? Generic point is management may be tempted to overstate its financial performance to the market, to boost its revenues, to boost its profitability. But of course, we have to use it as some evidence from the case as well. For example, we can see assets have increased too much. Profit is also increased. Okay, so we can talk about it further. Now, so students, starting from here. Delhi company was established 20 years ago and has become a leading supplier of machinery used in quarrying industry, with its customers operating quarries with extract stone used mainly for construction. Its customer base is located solely in its country of incorporation. But most of the components used in Delhi companies are imported from foreign country suppliers. What is it? It is foreign currency transaction. It is foreign currency transaction. Yes. We will talk about it. The machines and the equipment made by Delhi are mostly made to order in the company's 3 manufacturing sites. Customers approaches Delhi to design and develop a machine and piece and specific to their need, where management considered that design was significant. 30% payment in advance to fund the design work. The 70% is paid. This is the rest, sales revenue recognition. 1 point. Typically, a machine takes to build 3 months to build, and small piece of equipment on average 6 weeks. Now, so students, what is it? Work in progress. 2 points. Third point is this: foreign currency transaction. I'm just identifying points. We will discuss it. You see here, the Delhi company has successful stock exchange, raised significant equity. You see, you can discuss it in order to satisfy the new shareholder with this point. They had to raise significant amount of finance. And in order to do that, equity finance, they may have overstated. Yes, profits, assets. Now, the next point is, right, as a part of corporate governance was reviewed, so they say that 3 new non-executive directors and new finance directors were hired. A cash-settled share-based new finance director was hired. It can be a point as well. How? I will explain in a few minutes. A cash-settled share-based plan was introduced for the senior executives who will receive a bonus on 31st December 2017. The amount of bonus will be based on the share price from that at the date of flotation, which was 2.9 to the share price on this, on advice of newly appointed finance director. No accounting entries made. Now, so then let us discuss these points one by one first. Then we will proceed to the next. Come here. So, now, Delhi company, the first heading is newly listed company. Newly listed company. Delhi company is a newly listed company. Is a newly listed company. And it has raised significant equity after flotation. So, in order to attract the new investor, yes, in order to attract the new investor, it may have manipulated financial statement items such as they have not recorded any expense related to cash settled share based payment. cash settled share-based payments. Next point. So the one point we have given the evidence as well. Okay, from the scenario itself. Come to the second point. Give the heading foreign currency transaction. The company imports majority of its components used in the manufacturing process Yes, majority they are imported. Yes, imports. So the company, as per IFRS, any foreign currency transaction should be recorded at transaction date spot rate. While any closing balances at year end should be retranslated at year end closing rate. At year end closing rate. Now, what they have done, they have not told us anything. Silent. The risk is that they may not have used correct rates, correct exchange rates as mentioned above. resulting in misstatement of inventory and cost of sale in financial statements. Now, next, let us proceed further. So, student, it is done. Come to revenue recognition. Revenue recognition. There is no amount mentioned. The company receives, so materiality cannot be discussed here. Amount is not there. The company receives 30% payment from the customers in advance. Very easy to discuss it. Students, very easy to discuss. Now, as per IFRS, revenue should be recognized when performance obligation is satisfied. When performance obligation is satisfied. Performance obligation is, and performance obligation is satisfied when the control of the goods is transferred to the customer. So here in this case, so here in this case, 30% advance received from the customer should be recorded as liability slash deferred income in the financial statements. And should be recorded as revenue at the time of transfer of the goods to the customer. To the customer. Now, next. The next point is, students, but the risk is that the company might be recording the amount received advance, the amount received in advance as revenue at the time of receipt. Hence, the revenue may be overstated and liabilities understated. Liabilities understated. Now, next. So work in progress. I will tell you in speedy because I want to discuss more points. We have less time. Work in progress is, students, they take a lot of time. This is 6 weeks on average, 10 to 6 months, 3 months. So at the year end, they will have a lot of work. They may have a lot of work in progress, and they need to value it properly. The percentage completion of work in progress may not have calculated on appropriate assumptions by the company. Hence, inventory valuation may be misstated in financial statements. Now, next. So students, the next point is this cash settled share-based payment. Now I will explain it. Listen. Students, I would request you that be quick, read it once. Be quick, read it once. Try to understand what they are saying so that I can explain it well. Now, they say that, student, now listen, I will explain the treatment. As per IFRS 2, cash settled share-based payments an expense is recognized in profit and loss and a liability in statement of financial position based on increase in share price from the date it was granted. Yes, increase share price at year end. Yes. For example, they say that, you see here, they say it was 2.9. Right now, what is it? What is the price? What is the share price right now? 3.5. So now linking to scenario. So here, in this case, at the time of introduction of share-based payment plan, the share price was 2.9. And at year end, it is $3.5. So now at year end, it is $3.5. So an expense related to bonus payments to senior executive and liability should have been recorded. Should have been recorded. And the management here has not recorded anything in this regard. So expenses and liabilities are understated. Yes. Now, next point. Student, are you able to understand how to link, how to apply, how to explain? This is the skill you need to develop. It's not like whatever you come into your mind and you have to write that. No. You need to write and draft answer in a proper way. The finance sector recommended that the company's manufacturing should be revalued. An external valuation was performed in 15. Surplus of this, recognizing the equity. No deferred tax consequences. Deferred tax consequences are there. Wrong. 2 points are there. Revaluation is one issue. Deferred tax is another issue. Government grant is a third issue. Okay. So, students, I think it is enough for today. Enough. You can read this question yourself, a remaining point. I am here to explain. You can ask me a question anytime. and the assignment I have given to you. Must submit assignment in the next 72 hours. Please. And after doing that, drop a text message in the WhatsApp group that I have submitted assignment of the question, which one it was, whatever the name is. Okay. Do drop a message in the WhatsApp group. Anyways, students, thank you for joining me today. Those who have not enrolled yet, please enroll it, because I think it will be your last free trial class today. They will lock the links in the next class. Okay, so instead of facing any inconvenience at the time of class, do enroll. Okay, so thank you. God bless you. See you next week, next Saturday. Okay, take care. Goodbye. Goodbye, students.
Thank you, sir. Goodbye.
Thank you. Thank you. Goodbye. Goodbye.